Ever wondered why some businesses talk about margin while others prefer markup? It's not just accounting jargon. There's a fundamental difference that can affect your bottom line. Today, we're diving into the world of finance to unravel the mysteries of margin versus markup. But don't let the jargon scare you off. In this video, we will demystify these terms and show you how they can make or break a business. Think of it as your backstage pass to understanding the financial wizardry behind those price tags. You'll learn how a tiny percentage can mean the difference between profit and loss, and why markup and margin are like distant cousins with very different bank accounts. So, grab your curiosity hat and let's dive right into the world of margin versus markup, because in today's money game, knowing the difference can mean counting coins or counting losses. Let's get started. Imagine you're running a lemonade stand. You want to make money, right? There are two ways to do it, by focusing on margin and markup. Margin is like the slice of the pie you get from each glass of lemonade you sell. It's a percentage that shows how much profit you make compared to the selling price. So, if you sell a glass for $5 and your margin is 20%, you earn $1 in profit for every glass. Now, markup is a bit different. It's the extra amount you add to the cost to make your profit. If it costs you $2 to make a glass of lemonade and you add a 20% markup, you'll sell it for $2.40, making a profit of 40 cents. Here's the catch. Margin and markup can lead to different profits even if the percentage is the same, like 20%. For example, selling a bigger glass for 20% with a 20% margin makes $4 in profit. But if you use a 20% markup, you'd make $4 on a $20 glass too. So, the critical difference is what you use as the starting point. With margin, it's the selling price, and with markup, it's the cost price. Understanding this helps you figure out how much cash you're really raking in. So when you see those percentages, remember the magic is in the details. Now, let's dive into an example to make things crystal clear. Imagine you're in the business of selling shirts. You sell one for $120, and it costs you $100 to make. So, your profit is $20. First, let's talk about markup. Markup is all about how much extra you add to the cost price. In this case, your cost price is $100 and the markup is $20. To find the markup percentage, you simply divide the markup, $20, by the cost price, $100, which equals 20%. What does that mean? It means the cost price is 100%, and when you add the markup of 20%, the selling price becomes 120%. See how that works? Your selling price is higher than the cost price because you added that extra 20%. Now, let's flip the script and talk about margin. Margin focuses on how much profit you make compared to the selling price. In this case, your profit is still $20, but the selling price is $120. To find the margin percentage, you divide the profit, $20, by the selling price, $120, which equals about 16.67%. The cost price percentage is where it gets interesting. Since the selling price is $100 with a margin, the cost price is what's left, which is 83.33%. Here's the takeaway. Even though you have the same profit of $20, the margin percentage, 16.67%, is lower than the markup percentage, 20%. Why? Because with markup, your cost price stays the same at 100%, while with margin, your cost price changes based on the selling price. In a nutshell, when it comes to markup, the selling price is 120%, and with margin, the selling price is always 100%. Understanding this difference is like having the secret code to decode pricing strategies. Now, let's tackle a slightly trickier example. But don't worry, it's a piece of cake if you got the basics down. Imagine you're selling shirts again, but this time, they're priced at $50 and you've added a 25% markup. Here's the puzzle. What's the cost price? Remember, the cost price isn't the same for markup and margin. With markup, the cost price is like your starting point. It's 100% of the puzzle. But in this case, we're adding a 25% markup. So, your selling price is already 125%. 100% cost price plus 25% markup. Now, we're on a quest to find the cost price. It's like solving a mystery, right? Here's how you do it. You take the 100% cost price that you want, divide it by the selling price, which is 125%, and then multiply by the selling price, which is $50. The result? Your cost price is $40. See how it works? Your $40 cost price plus a $10 markup add up perfectly to the $50 selling price, just like magic. Now let's tackle that same example, but this time with margin. Imagine you've got a 25% margin. Like before, it's the same percentage as the markup, but it leads to a different outcome. With margin, the selling price starts at 100%, and the cost price plus the profit should add up to that. So, we subtract the margin, which is 25%, from the 100%, giving us a cost price of 75%. Now that we've got our cost price percentage, we can calculate the cost price itself. We take the 75%, divide it by the selling price, which is 100%, and multiply by $50. The result, your cost price is $37.50. Here's where it gets interesting. With margin, your profit is $12.50, $50 selling price, $37.50 cost price. Remember earlier, we talked about how, for the same percentage, margin can give you more profit than markup. Well, here's proof. You're making a $12.50 profit with a margin compared to the $10 profit with markup in our previous example. Take a look at the chart here. It shows that for the same profit value, margin percentages are lower than markup. Markup always scores higher. For instance, if you have a 20% margin, the markup is 25%, and the pattern continues as the margin increases. When the margin is 60%, the markup is 150%. When the margin hits 75%, the markup soars to 300%. In a nutshell, always remember that with margin, your selling price starts at 100%, and with markup, your cost price begins at 100%. Understanding this and the denominator trick, margin divides profit by selling price, while markup divides profit by cost price, will help you master these two essential concepts. I hope that clears things up. Now that we've unraveled the secrets of margin versus markup, it's time for you to put this knowledge to work. So here's a question. How can understanding margin and markup benefit your business or personal finances? Drop your thoughts in the comments below. We'd love to hear your insights. And if you found this video helpful, remember to give it a thumbs up and share it with your fellow coin counters. Plus, if you want more tips and tricks, make sure to hit that subscribe button and ring the notification bell so you never miss a Count and Coins update. Thanks for joining us on this journey through the world of finance and accounting. Until next time, keep counting those coins.